Welcome, everybody, to our webinar today regarding becoming your own bank. I am just going to go ahead and share my screen so you can take a look at the presentation along with me. We're happy to have you here. If you happen to miss this and you're catching it on a recording, we look forward to meeting you. You can always respond to us at Beth at The Abundant Investor. I'm glad to answer any questions. That's again, Beth at theabundantinvestor.com. And I'm glad to talk to you about your specific scenario anytime. Okay, so becoming your own bank. This is a presentation today really for EXP agents. Everybody that signed up today are EXP agents. So you're likely also either an investor in real estate or a wannabe investor in real estate. So you're at the perfect spot. We're going to talk today, I'm going to talk today about how you can use properly structured life insurance to become your own bank, to gain a lot of benefits as both a real estate agent and a real estate investor. So with that said, let me jump into the agenda here. So I'm going to tell you a little bit about my background in the Abundant Investor and how we ended up at EXP. We are agents. I am an agent here at EXP. And then we're going to get into really the meat of the program around why is this so important? It's something worthwhile taking the 30 minutes or so it will take us to get through this webinar today. So as far as my background, my name is Beth Rooney. I started my career at Fidelity Investments, not in real estate. And I was there for about 12 years, and they relocated away from my home here in Greater Boston to Rhode Island. And I decided at that time to get into real estate. So I sold real estate for a couple of years, and then I had the great fortune of managing some of the biggest offices in and around Boston for almost 15 years. I worked for both Coldwell Banker. I worked for Caldwell for about 7 years, and then I went to a large regional firm called William Ravis Real Estate, and I managed for them. So I opened several offices. I've recruited, nearly 1,000 agents. I've overseen thousands and thousands of transactions. And a couple of years ago, I was getting a little bit tired of being a manager to real estate agents, and I wanted to make a shift in my career. So I hired a coach. Her name is Christine Fisk, and she really helped me make this change. Of course, it was difficult to do because I had a non-compete with my current company at the time, and they made it very difficult for me to leave, those golden handcuffs, right? So we were spending a lot of time going back and forth, and Christine's advice to me as my coach was lean into what feels good and don't fight this so much. And it was great advice. And as I sort of let go of things and just let the universe provide me with the next step, my former colleague from Fidelity Investments out of the blue reached out to me with a great opportunity to come work for him. So I, 2 years ago, went back into financial services. I got my Series 7, 63, and my life insurance license, because that business is a business called 3C Structures, where we structure life insurance policies for the country's most affluent high net worth families. And so why am I telling you all this? Well, I'm still doing that, and it's very fulfilling, but it does not take a lot of my time. And I sort of missed the real estate world. It was sort of tugging at me to come back. So about 4 months ago, I put my license back with EXP, and my business partner, Christine, got her license. And we have a business called The Abundant Investor, where we help women and a few good men learn how to invest in real estate. We teach them how to build wealth through real estate, and we teach them how to fund it using properly structured life insurance, which gets us to today. So I am combining my two worlds of financial services and really in-depth information about real estate, and mostly in real estate, managing real estate agents. And one of the things I've seen with agents is there's really two big themes here. One, they don't invest in real estate as much as I would have thought they did. should, and they have a front row seat. They tend to know the markets better than anybody. Why don't they invest more? And I think that's because of two. The second reason is that real estate agents don't do a great job managing their finances. And I hope this webinar today can address those two things, because as an agent, we all know income can be up and down. And there aren't really a lot of programs to automatically save money into retirement planning. So I'm going to give you some ideas today on how to smooth out that sailing and start to put money away, and then how to use that money to invest in real estate, all with the goal of being less reliant on transaction business and more able to rely on your own personal wealth in building your personal wealth. Okay. So that's my background. That's why we're here. So let's talk about the reality we're facing as independent contractors. We're going to talk about the 3 buckets you get to put your money into, how taxes are such a crucial part of this. I'm going to talk to you about investment vehicles, and an overview, and where does this life insurance policy fit in, and then savings and investment strategies, and why a properly structured life insurance is so important. And then to the meat of the matter, how you can become your own bank. You're going to hear me use the word properly structured a lot. It's really on purpose, right? If you're taking notes, write down the words properly structured, because it's really important. Okay, so there are 3 buckets for you to be able to save your money in. And this is information that you probably all know really, really well. We have your taxable bucket. And those are things like your CDs, your savings account, your checking account, your straightforward brokerage account, which could have some mutual funds in it, that kind of thing. That bucket is 100% taxable. You're putting after-tax money in it. It's growing. And if it's kicking out dividends, you're paying taxes on that as it goes. Or if you have an investment in there and then you sell it, you're paying capital gains tax, okay? It's actually a good bucket to have money in for like your 6 months of savings in liquid or near liquid assets, okay? But beyond that, any investing is probably not the greatest way to invest, because that money is taxable. Then you have your tax deferred bucket. And a lot of us, a lot of real estate agents came from a world where maybe we were 9 to 5 and had the opportunity to have a 401k, or if you're a school teacher or work for a municipality, you had a 403b. Those are not obviously available to us as independent contractors. So we use things like IRAs. Well, an IRA, you can only put so much money in it. The government limits that. It's $7,500 right now. And then you could also invest in a variable annuity, which is doesn't really give you a big tax benefit now, because it's after tax money, but it does grow tax deferred. But when you take that money out, just like when you take it out of a 401k or an IRA, once you're 59 and a half, you do pay taxes on that. So there's tax deductions for these accounts, especially the first 2 up front. They're tax deferred along the way, but when you access those funds, you are paying taxes. For variable annuity, it's just on the growth, not the initial investment. But for the other 2, it's on both, because remember, you never pay taxes on that. So it's a good tool. I think it's a little bit overrated, in my opinion, because you're going to have to pay Uncle Sam, and it's likely that maybe you're at a higher tax bracket there. So my point is, don't feel so bad if you don't have the ability to save in a 401k, because you have this 3rd bucket, which is your tax-free bucket. And that is things like your Roth IRA, which again, it's a great bucket, but you can only put so much in. It's $6,500 up to a certain age, and then it's $7,500 after that. So again, with a Roth IRA, it's post-tax money, so you've already paid taxes on it. It goes into a Roth IRA, it grows tax deferred, and then when you take money out, it comes out tax-free. It's great, but the problem is, once you take money out, you can't put it back in. It's like putting toothpaste back in the tube. You can't do it. So you really can only use it once. With properly structured life insurance, it's similar to that, in that you've already paid taxes on this money, so it's post-tax, it grows tax deferred, and then you can access that money anytime you want, tax-free, by taking a loan. And you can use that money, let's say invest in real estate, pay yourself back, and have it continue to grow. Now, one of the really amazing things I'm going to talk about today is the fact that you're not taking your money out of the account like you would take your money out of a bank or a Roth IRA or anything else like that. You're not liquidating it. You're borrowing against your future death benefit. So you're borrowing really from the life insurance company while your underlying investment, your underlying contribution is still continuing to grow with what's called uninterrupted compound interest. So you're not taking that out of its ability to earn interest. You're borrowing from the life insurance company against that future death benefit. So, for example, if you had a policy where you had put in premiums of, say, $100,000 and you had and you wanted to access $50,000 to put it down on anything you want, a real estate investment to pay for your kids' college, to pay off credit cards, whatever it may be, you could take that $50,000 out. Meanwhile, that $100,000 is still getting annual interest and growing with compound interest, which is amazing. And you can, let's say you bought a fix and flip and you made some money off of that $50,000. Let's say that $50,000 is now worth $70,000. You could take that initial 50 and put it right back into the policy and use it again down the line to invest in, say, another real estate policy. So I put it in the same bucket as a Roth IRA, but it has a lot more benefit to it. And then there's also Roth conversions, kind of like a Roth IRA. Okay. So those are basically, that's it. Those are the three types of buckets you have to invest in. Now, I'm going to jump into taxes and why this is so important and why I mentioned earlier that maybe a 401k is a little bit overrated, because this is the history of the highest federal marginal individual income tax rate over a period of time. And you can see in our lifetimes, at least in my lifetime, the top bracket was up in like the 60s, 70s. It's come down significantly. And the question is it going to always stay there? Is it going to go back up? Well, any politician, whether, I don't care what you, if you're a Republican or Democrat, nobody wants to say they're going to raise taxes. However, we have this thing called the GDP, and it's growing. And it's growing at a tremendous rate. Right now, our debt as our country is $32 trillion with a T, okay? At some point, we're going to have to pay that back. And how are we going to do that? Well, we can reduce spending or we can increase taxes. That's about all. Those are really the two levers that politicians get to pull on this. So my point is, with this situation and the situation that we're in with Social Security, there is a good chance that in our lifetime, we'll see those tax brackets go up. Also, when people are older, they tend to be earning more money and have less write-offs because maybe the kids are out of the house and that tax write-off is gone. So the fact that you are taking money out of things like a 401k and paying taxes later isn't that terrific, because you could be paying at a higher tax rate based on your own circumstance or based on the circumstance that our country is in. Okay, so that's the reason why the taxes are so important to think about and why it's great to really consider using that tax-free bucket. I've talked about some of this stuff, but I just want to lay it out in a little bit of a different way. These are the types, some of the popular account types you've heard and how you can use them. So things like an IRA or 401k, not great for emergency fund because you can't access it without a 10% penalty and paying taxes on it until you're 59 and a half. It's not great for real estate investing. You can borrow against it for your primary residence, but if you're going to be investing in real estate, that exception doesn't work. Not great for college. Great for retirement and great for sort of your dreams, okay? A Roth IRA, this is going to have those same issues. You can't really access that money until you're 59 and a half. Good for retirement, good for sort of your big dreams. 529 plan, not a place for an emergency fund, not a place for real estate investing. It really has one sole purpose, and that's to pay for your children or your grandchildren to get higher education. and not for retirement, not for, buying that boat of your dreams or anything like that. Okay. Then your bank's in a taxable account. Excellent for emergency fund that I've talked about before. Okay for real estate investing. Although when you pull the money out of that bank, you're no longer getting compound interest. Okay for college. Not great for retirement because while you can use the funds here, if you're putting money in a taxable account for a long time and that's growing at a slow rate, you're going to actually end up losing money because of inflation. So, and if it's growing and at great rates, you're probably paying a lot in taxes because there's no tax shelter whatsoever if you're just putting it in a taxable account. Okay. So a high cash value, properly structured life insurance policy is something that you can use for emergency funds, as I mentioned, for real estate investing, for college, for retirement, to make those purchases of your dreams. Maybe it's vacations or boats or anything like that. So there's so many fewer restrictions around how you access the money that you put into this account. Okay, so there are two types of insurance. There's term insurance and permanent insurance. Okay, what we're talking about today is this permanent insurance. But many people own term insurance. And so I want to just explain the difference between the two. You can think of it as renting versus owning in life insurance. Okay, so term insurance, just as the name suggests, is available for a certain period of time. It provides coverage for, typically between 10 and 30 years and any increment in between. It generally offers the lowest premiums of any life insurance type, especially if you get it while you're young and healthy, but it does not build cash value. It offers a death benefit for the duration of the policy. But if that policy expires before you die, you get nothing. A really important number to remember here, and again, if you're writing notes, I'd write this down. Term insurance only pays out 2% of the time. That means that 98% of the people that buy term insurance die without the policy in effect. I guess that's good news because you've outlived the policy. But the bad news is you spent all that money over the years with nothing to show for it. Okay, versus a permanent life insurance policy. Now, in a permanent life insurance policies, there are different types. I'm going to talk today just about whole life in an IUL, Index Universal Life. Okay, and as the name suggests, it offers coverage for the entire lifetime of the insured. You can build cash value over time with access to the cash for the policy holder, and you can loan yourself money and pay yourself back over time or not. It's really up to you because, again, you're borrowing from your future death benefit. If you die with an outstanding loan and your family has $1 million death benefit and you have a loan out for, $50,000 in my previous example, they get $950,000, not $1 million. So they get whatever the death benefit is minus any outstanding loans. It's a very simple thing. It's a great concept to think about living your life now. We call this living your rich life now. And it's really an important feature of using properly structured permanent life insurance. The premiums are going to be higher than for term insurance, but it does offer that death benefit for life. So guess what? I gave you the number 2% over here for term insurance. Guess what? The percentages of people that die and they keep their policy in force through a permanent insurance. It's 100%. If you keep that policy in force and you die with your permanent insurance policy in force, your family is going to get a death benefit 100% of the time. Big difference. Okay, so we're going to talk about properly structured permanent life insurance, okay? And the properly structured is about how much of your annual premium is going towards your death benefit and how much of that is going towards your cash value. The US government has rules around that ratio. You can't just have a little tiny bit of death benefit and all this cash value and get all these great benefits. So you have to have a minimum of a certain amount of life insurance based on your age, your health, your income. So when we structure a policy for you, what we like to do is reduce the death benefit to as low as possible to keep the IRS happy, and the rest of your premium should be going into your cash policy, the cash balance, which is the part that you get to access and put back in and use for things like real estate investing. So I hope that makes sense. But it's if you may have heard of people saying, well, wait a minute, permanent insurance is really expensive and I'm only getting a little bit of cash value. That's because the life insurance agent didn't structure it well. And I have to say, since we're all commissions, we're all 1099s, and I'm a life insurance agent as well, the life insurance agent mostly gets paid on the death benefit piece of it, not the cash value piece of it. I am talking about doing just the opposite, reducing my commission to as little as possible to keep that IRS happy, and so you can put as much cash value in there, keep the cost as low as possible, and then use that to grow your ability to borrow from it and everything else. So it's a lot different than maybe other life insurance agents have structured, and that's why properly structured is so important. My goal is to benefit you, not to benefit me. And if I do a good job, you're going to tell your friends, and we'll grow our business. It's a very simple concept, but it is misused quite often. Okay, so we have a properly structured permanent life insurance policy. Well, what does that do? It grows tax-free. Your cash value is fully accessible. So if I start a policy today with the life insurance company that I have my policy at and that I typically use with my clients, I could access that money as early as a week after I open my policy and make that premium deposit. So it's not 100% of my premium, because again, every time I make a premium deposit, a piece of that's buying the prerequisite death benefit that I have to keep the IRS happy that this is a life insurance policy, and a piece of it's going into my cash value. And we're going to try to keep the ratio as high of cash value as is possible. So you have the cash value fully accessible. You have flexible premium contributions. So unlike the max Roth IRA, where you can only put $6,500 in a year, you can put in a lot more. It's the most you can put in will be based on your age, your health, and your income. So we will work together to figure out what is a comfortable number for you for an annual premium. And that will be sort of at the top of your range. And you'll always have a minimum and you'll know what that number is. So for example, if you're putting $15,000 a year and you're somebody that's about my age, your minimum would be around, I don't know, $4,000 or $5,000. So if there's a year where you can't afford to put the full 15 or full premium in, you will know from day one what that minimum premium is and to keep the policy in force. So you keep that death benefit in force, which is really, really important. But you'll know what that number is, and there's some flexibility in that year to year. You have additional living benefits, and this is why I am so passionate about this, because I've managed hundreds of real estate agents who are fully exposed without any kind of a backup plan. God forbid they get some type of a chronic illness, some specific medical condition, and they can't work, or God forbid a terminal illness. And I've seen this happen with my agents. We all know that if you can't be working, you're not getting a compensation. And real estate agents are of the most exposed group of hardworking people out there, because they're 100% commission. And this permanent life insurance policy allows you to access even more of your cash value in that future death benefit if you have one of these three scenarios. So let's just say, God forbid, you have some type of a chronic illness and you're unable to work, and your death benefit is $1 million. You can access a big portion of that death benefit to help cover your daily living expenses, your hospitalization, your medical bills, or that trip you've always wanted to take. It's up to you on how you spend that money and if you pay yourself back. But it's a safety net that is, keeps me up at night that agents don't have that safety net. So it's a beautiful thing. It's a tool, permanent life insurance is a tool that wealthy families and institutions like banks have used to build wealth for decades. And it is available to everybody. It's just not that spoken about too much. Why? Well, it's a little bit of a higher level concept for people to understand. It requires doing things like sitting on these webinars and getting educated. The life insurance companies, if I'm a life insurance company and you're buying term insurance, wouldn't I rather see you buy term insurance because I know the likelihood of me ever having to pay you out is only 2%. So it gets a lot of the advertising dollars and education and attention out there is term insurance because that's where the insurance companies are making their money. But permanent insurance, don't get me wrong, is a massive business. And if you'd like to see what happens when you put your money in a bank, Google bank-owned life insurance. The acronym is BOLI, bank-owned life insurance, and look at how much life insurance our country's biggest banks own. Because when you put your money in a bank, typically they're buying a lot of life insurance with that money and lending that out, just like we're talking about being your own bank and letting that money grow with compound interest and paying themselves back. It's the same exact concept that's available to you as an individual. All right. So how does permanent insurance allow you to be your own bank? Well, inside of your life insurance, as I've mentioned, you get to create your bank. Okay. And that bank allows you things with like control of your assets, tax-free growth. It's private. So this is a great way to say pay for college, because if you are like me and you have kids in college, you fill out a FAFSA, you have to claim that 529. It's not private. The life insurance policy is private and does not show up on the FAFSA account. You can leverage this policy. We're all in real estate. We know about leveraging. You can leverage this policy, and then it, of course, provides this death benefit. So your bank is where your money grows tax-free and it grows tax-deferred, and then you could borrow it tax-free, and it earns uninterrupted compound interest. So you can take a cash loan and you can come over here and you can invest in real estate, pay for college, buy a car, buy a boat, and then over time, pay yourself back with interest. So if you have a real estate investing business and you have an LLC, that LLC can actually borrow the money and pay yourself back and pay back with interest into your account. It's mind-blowing. Talk to your accountant about it, but that's even a higher level benefit than everything that I'm talking about here. So you're able to make purchases, take a loan from your own bank tax-free, and decide whether or not you're going to pay yourself back. We strongly suggest that you pay yourself back, especially from this top box here in real estate investing, so you can do this over and over and over again. Again, putting the toothpaste back into the tube. Okay, so there are two types of permanent life insurance, and I won't know which one's best until I speak with you and really learn about your individual needs, goals, wishes, desires. But here's a high level about what they both are. Both offer tax-deferred growth of cash value. Both offer policy loans and withdrawals, and both offer a death benefit. A whole life is going to have fixed premiums and a fixed cash value. It's going to have a guaranteed minimum interest rate. It's going to pay annual dividends. And now I can't say those are guaranteed, but most of the mutual companies that we speak with have never had a year where they didn't pay dividends in over 120 years. So this is the type of like A++ companies we're talking about. And there's lower potential returns because this is your whole life is going to be sort of your steady Eddie, right? This year, my return, my annual dividend was just over 5% for the company that I use. For an IUL, an index universal life, the premiums are going to be variable. Your cash value is going to vary a little bit because you're using an indexed strategy that is based on market indices, like let's say the S&P 500. It's going to have a downside, guaranteed downside protection. It will never go over zero. You're not going to get the full height of the market. You're going to get something, some range in between, and depending on the product, and then within that product, which index we choose, and then which range that we choose within that, it will change. It will vary sort of greatly. But again, I can't say much more about that until I get to know you, understand your goals, needs, wishes, risk tolerance, and all that kind of great stuff. But know that there are two different types. I tend to suggest using whole life when you're thinking about investing in real estate, because it's much easier to understand what your cash value is. You sort of know what's there, and it's not as variable as an index universal life would be. Okay, so how do we work? Okay, so we have we have me here at the Abundant Investor. I am insurance licensed, real estate licensed. I'm going to help you with this overall finance and real estate strategy. Like, when should you be using this money? We do a lot around money mindset coaching, because a lot of this really comes down to your mindset, and are you willing to take the time to get educated, to try something that's new or different that maybe you haven't tried before. And both my business partner, Christine, and I have our own policies. Christine is a real estate investor. She's not life insurance licensed, but she does have a life insurance policy, and she handles a lot of this money mindset coaching. That's her strength. My strength is that I am licensed. I can talk to you about this. I can set up policies for you. We are both real estate licensed and understand for sure what it's like to be a real estate agent. Okay. And optimizing your policy is something that's really important. So we are not going to sell you a policy and you're never going to hear from us again. We are here as business partners with you, to meet with you throughout the year, to understand how it is that you want to use your policy, to be a sounding board on how to optimize that policy, whether or not it's time to start a new policy or add to the existing policy. That's our role. And then we work with major carriers like Mutual of Omaha, Lafayette Life, Nationwide. There's a long, long list of carriers that are available to us. And our goal is to optimize your wealth and your big goals. So we structure that policy to optimize your personal goals, not ours. We meet for an annual review, but with most of our clients, it's biannual. And we support you anytime you have questions around, should I be using this policy, or should I be using other types of investment money that I have available to me? We're here as a sounding board for you. So, the summary here is, why is this so important for real estate agents and investors? You have tax-free growth. You get uninterrupted compound interest even while you have a loan balance out. You have your cash value is fully accessible to do whatever you want to do with it. You have premium flexibility on your premium contributions. You're going to decide how much annual contribution you want to make, and then we'll build our plan from there, as opposed to the government deciding for you that the most you could do is $6,500 a year. You have these living benefits, which are so important if you're sick and you cannot work. This is a tool that provides so many benefits and reduces so much of the risk that real estate agents faced. It can be a safety net. I can be here to help you with that. It can be a safety net for things like health issues. It can provide a great source of funds when investment opportunities come up, because sometimes we never know when that's going to happen. It's very, very pliable, very, very flexible. And I would love to learn more about you, and if this is something that's of interest of you. If you would like to learn more, send me an email at beth@theabundantinvestor.com. I will send you a link with some questions about you. It will take you less than 5 minutes to complete, and then we'll schedule a personal one-on-one meeting to get the process started. When we meet, I'll review a sample illustration tailored to the needs that I learned about at this one-on-one meeting, and we can make changes, give you all kinds of different scenarios, answer all of your questions, make any revisions as needed, and then take it through from there. It's a very easy process and something that is really going to be tailored to you and your needs and what's important to you. So thank you for listening. You have my email address. I look forward to hearing from you, and let's go EXP.